theory of integration. We're going to talk about theory of integration with respect to an individual and a corporation. Income from a corporation should not be taxed any differently from business income earned directly by an individual as a proprietor. The theory of integration must apply to different sources of income. So when you're looking at different sources of income, you're looking at business income, you're looking at investment income, and capital gains. So there are three different types of income, but they're taxed differently in a corporation and they're taxed differently as an individual. So the theory of integration applies with respect to all these three different sources of income. Okay, so let's talk about an individual as a proprietor and an individual as a corporation. So let's say the individual earns $200,000 in profit running a business as a proprietorship, and he's paying about $80,000 in taxes, and he's left with net after-tax income of $120,000. And here the individual is running the business as a corporation. So as a corporation, he's going to pay corporate taxes, and then after he pays the corporate taxes, he will be left to pay dividends out of retained earnings. Let's assume that he pays all the dividends from the retained earnings, that all the income eventually goes back to the shareholder. So the reality is that the theory of integration states that after-tax dollars to the individual as a shareholder or a proprietor should be equal at the end of the day. However, there is an opportunity for deferral of taxes as a corporation because the Revenue Canada wants small businesses to be successful, and they want the profits of the corporation to be plowed back into the corporation to expand the business. That's why there's taxes at a lower rate for a business as a corporation than as a proprietorship. And there's a substantial opportunity to defer your taxes by having a corporation.